counting down to the August employment report for insights on how it may impact the markets and the Fed. Let's bring in Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Some good stuff in your notes. The VIX typically increases 25%. Between July and November in election years. So let me just, how much is it already?
It's already gone up a lot.
It has, so.
And then it's come down a lot. But I think the idea is that you see a lot of volatility from July to November of election years. And this year is true to form. We've seen the VIX hit, kind of a post-COVID high back in July. And, we're back down. But I think the name of the game is don't be a hero.
Billy, don't be a hero.
Don't be a hero. What's that?
It's a song. Billy, don't be a hero. Yeah, long ago.
Are you going to break out into a song?
No, but I saw that in your notes. Don't be a hero. Stick with income stocks, quality stocks.
Income and quality. And I think that we are at a point where the large cap value benchmark looks amazing. I think utilities, real estate, companies that offer inflation-protected yield, income for folks that are parked in money market accounts that are about to see a little bit of a drop in their cash returns. So I think that's the idea here, is just to park in safe, total return type vehicles where you get paid to wait. And I think there is a lot of election uncertainty ahead. So we've got, kind of a divisive view on fossil fuels versus green. So what do you do with energy at this point? That's a big question mark. You've got, immigration policy. So there are a lot of binary kind of outcomes that I think could roil certain parts of the market.
Still at 25, though. And you say the bar would be really high. So
25 basis points
25
for
basis
September,
points.
yeah.
And you do think things are weakening, but not to the point where anyone's going to panic at this point. So you expect the number today, it's going to be like around 150, you think, or something?
I think our guys are forecasting 200. They're 200. More optimistic.
Are they?
Yeah.
Okay.
And I think that, really, if you saw something weak, you could get a 50 basis point rate cut, and that's certainly on the table. It's being talked about more and more. But I think the idea is we're about to see our first rate cut. This is important. Like that's the move.
In years. Yeah.
And it's been a while, and the Fed has done a good job of moderating inflation. Maybe they started too late, but they quashed it, and we're now at a point where they can actually start cutting interest rates.
You don't like illiquid things or deep cyclicals, so you still are giving some credence to the slowdown.
I am, yeah. A lot of our models are suggesting that, everything that I look at, the data on consumer spending, slowing, it's not terrible, but it is slowing down. We're seeing, kind of a normalization in a lot of these hot economic measures. And then on top of that, what I think is interesting is that we haven't really seen a lot of turnover in areas like residential real estate or, kind of illiquid assets, private equity. We haven't really seen marks, private credit. So those are the areas where, unless long rates come down considerably, which, I don't think that's as easy to forecast, it's an environment where we could actually start to see price discovery in some of these areas like residential real estate that could reset lower rather than higher. So normally when the Fed starts cutting interest rates, affordability becomes better.
You think it's going to become worse?
I think in this cycle we're going to see the true value of homes, which we haven't necessarily seen yet because we haven't seen a lot of turnover.
We were talking to Leslie Picker in the last hour about the IPO market, about private equity exits, about all sorts of things, and she was trying to be optimistic. It sounds like you're not.
I think that things are okay, and the good news is that these companies have a long period of time to work out their issues. But the problem is that private equity...
It's not really okay. The kids are not all right. Let's be honest. Right now, there's nobody exiting anything.
Right.
It's
I think there's a lot of...
up and everyone's sitting on their hands.
Up.
And that's going to become a problem at some point. And so many people are actually in the private equity space, basically taking on debt, sometimes on top of their whole fund.
At a much higher cost. Yes. Exactly. So I think that's the issue. There's a lot of private equity. There's different types of private equity and private credit. Some are good, some are bad. What worries me is that a lot of capital was raised between 2017 and 2020. So private equity, I think assets doubled during that period.
Right. So you think that vintage is just going to be...
Well, that vintage, think about it. Was anyone talking about 5% interest rates and inflation and with a 3 handle? No, we were all in like lower for longer, everything, 0 interest rates forever. You know, so those deals were struck at expectations that were probably much more benign than what we're facing today. So that's what I worry about. I think the S&P 500 is fine. I mean, these are companies that are marked to market on a daily basis. They reflect the reality around us. You know, this is a liquid vehicle of large cap companies. They're scrutinized. You know, these are the most scrutinized companies in the world. So I think that this is an area where you have a lot of transparency. What I worry about are the areas that are less transparent than U.S. public equities.